Good afternoon. Welcome to the JSE Stock Picks show. My name is Sam Grossi. I'm your host this afternoon, and looking forward to some really excellent conversations around some interesting uh, uh, companies that our panel of experts has chosen as their stock picks this afternoon. On our panel, we have Khumalo, who is the portfolio manager an investment analyst at Vestact Asset Management. We have Boitumelo Letsuma, who is an independent global market analyst. And then we've got Simon Brown, founder of Just One Lap, and Lonwabo Maqubela, portfolio manager and deputy chief investment officer at Perpetua Investment Managers. So welcome to all of you. Really looking forward to hearing which companies are on your pick this afternoon. But to get things underway, Bright, why don't you tell us, the audience, a little something about yourself that maybe folks in the market don't know? You've been on this show a few times, so maybe I don't know if there's any surprises left for us, but maybe you can give us something that we might not know about you, and then you can dive into your three stock picks.
Yeah, there's always a danger, in giving too much about yourself on the internet these days, since everyone is trying to hack your bank account. So the less I give, the better. That's what I got for you today.
I do know that you love your fire emojis when people that know you are watching. So that could warm us up on this cold Johannesburg afternoon. Why don't you dive into your stock picks?
Yes, thanks, Sam. I'll get the ball rolling there with my stock picks without taking much time. So the theme for me today is pretty simple. We watch a lot of shows on television, and we analyze people's portfolios. And the most common thing I see in people's portfolio is that they don't have anchor positions. So these are the guys that watch us talk about stock picks, and they pick and choose what they like and what sounded the best that day, but they don't actually have anchor positions. So today I'm focusing on three anchor positions: Naspers, Richmond, and Capitec. So let's get started with Naspers. I like Naspers because despite all the noise around, obviously, their structure and governance, it's still one of the best ways to get exposure to Tencent and one of the most profitable, obviously, internet businesses globally of our time in recent history. So Tencent is still a really good business, regardless of what's happening, in the regulatory environment in China. So yeah, you're effectively getting that business at a discount when you get it through Naspers process. The reason why I like Naspers, the discount is a bit larger than in the process structure, which gives you obviously the patient investor a margin of safety. So if you add, other interesting catalysts in the mix, like a new CEO in Bliozzi, I don't know if I'm saying his name right, is somewhat of an operator, unlike the previous CEO, which, he sat down and collected a lot of income, but he had nothing to show for the shareholders. So we're talking about an active guy. You might have read um, his letter to shareholders that is actually doing quite a lot of things. So I won't bore you with the details of that. You can go on the website and look at it yourself. And obviously, what's going to make a big difference for Naspers is a good smart capital allocator at the top. And I think Fabricio might have actually the potential to get the things going there to close that gap for the Naspers process towards Tencent, and maybe continue selling down and buying shares back. We don't know. We can't tell him what to do, but we're watching actively, with bated breath there. And if you look at the share price performance in, since it took over, the market sort of giving him the thumbs up for now, but, a lot remains to be seen. So there's a lot of opportunity there at Naspers. My second pick is Richmond, which fits well with the long-term sort of mentality of an anchor position. Because, I mean, luxury by itself doesn't go out of style, especially for brands that have, rich culture, history, and craftsmanship. Think of Cartier, Vacheron Constantin on the watches side. You think of Mont Blanc. And don't discount the power of jewelry and the top 0.0%, 0.1%, and the ability to keep buying through ups and downs of the market. We always talk about, the wealth effect and how it supports, luxury high-end goods, particularly from Chinese and Middle East. And obviously, we've got the West in the US and European buyers as well. So I like Richemont as a long-term holding when it comes to that. It sort of, follows its own earnings in terms of what the share price does. And in those instances where it goes down because of the market, it quickly re-rates once things get better. So I like this one as a long-term holding. So yeah, it's much better prepared than most to weather those macro, shocks. The last one is Capitec, which remains one of my favorite local stocks. It came through, as a disruptor in the banking industry and still behaves, like, a very agile, fast-moving fintech company. I like that. They've built a massive, massive loyal customer base while keeping costs low and consistently delivering solid return on investments there. There's no story like Capitec. They've outsmarted the guys at African banks, and obviously they're coming for the business of the top four banks, and if there's a company that can deliver on that, without making a lot of noise about it, it's definitely Capitec. It's a rare find in a bank, that kind of growth and DNA, tied at the hip for that company. So yeah, I like Capitec. Even though the market sort of is fully aware of what Capitec can do, Capitec continues to just keep on delivering. So yeah, those are my three top picks. I'm looking forward for those questions. Thank you, Sam.
Thanks, Bright. You mentioned something right at the beginning. You mentioned anchor positions. Can you just unpack that a little bit?
So look, these are sort of I don't want to use the word boring, but these are the
Okay.
type of companies that are stable. They have, lower volatility matrices attached to them, or betas are closer to one for the stock market nerds out there. But these companies, naturally, you will never find them, trading at a discount. But you need them in your portfolio. They typically tend to be well diversified, whether it's through vertically in their business or geographically. Think of Richemont, where they operate. There's a Richemont in every major city or major capital in the world, where you can go find one of their shops and you can actually buy their stuff there. So these are not businesses that are going to shoot the lights out overnight, but also these are not the businesses, if something bad happens or we have a macro shock in the market, they're going to tank a lot. So these are, you never get them at a deep discount. And also they're not going to increase 600% in the next 2 years. And when they do, you wish you would have had them in your portfolio in the first place.
Right.
So yeah,
Right.
those are the type of businesses they are.
Right.
And you sort of, when you're in the building blocks, they're part of your building blocks when you're building a long-term investment portfolio. So you start with these before you invest in anything everybody in this group is going to tell you to invest in.
Shots fired. So Boitumelo, let's hear your response to Bright's fired shots. Maybe tell us a little bit about yourself. Maybe don't know if you want to go incognito like Bright. But before we get into your stock picks, we'd love for the audience to get to know the person behind the professional.
Awesome. Hello, everyone, and thank you so much for having me. My name is Boitumelo, and I am an independent analyst with experience in both local and global capital markets. Something interesting about me that I'll be doing soon is hosting a party for my 85-year-old grandmother. And yeah, I'm really looking forward to that next week with the
Beautiful.
family.
Congratulations.
Yeah, definitely. So yeah, I don't want to rain on your parade, Bright, but yeah, I've also got a portfolio of stocks that I think, are worth holding long term. And my first stock pick is Shoprite. I believe that the company is backed by a capable and forward-thinking management team that has been seen strategizing and focusing on its core food retail operations through its Shoprite, USave, and Checker stores, along those adjacent products and stores. The business has delivered solid sales growth, and although profit levels have been high, earnings growth has been slightly moderate. However, its financial position remains healthy with sufficient capacity to manage debt. And in line with its main focus, Shoprite has been divesting from some of its non-core high-risk operations, as seen through its exit from Kenya and Madagascar, as well as the sale of its furniture business to Pepkor, which includes stores like OK Furniture as well as House and Home. And this will allow the firm to focus on its new store expansion plan of 151 stores. They also have committed to investing in technology, which is aimed at reducing, wastage in areas affected by power instability, while improving efficiencies in its delivery business. And speaking of its delivery business, Shoprite also acquired the remaining 50% of Pingo, which is the logistics engine behind the 6060 delivery service. And this has significantly contributed to revenue towards the end of last year. And its Extra Savings Plus program also continues to offer an additional sales stream through its subscription model. Overall, Shoprite has maintained a stable dividend while doing the Lord's work through affordable daily meals that provide value to price-sensitive consumers. And yeah, I just think with a strong leadership team, consistent dividends, and smart capital allocation, I think Shoprite remains a compelling long-term investment. And my next stock pick is, oh yeah.
Sorry to interrupt there,
Sure.
Dewey. This whole delivery 60/60 thing.
Yeah.
Speaking of parties, that's my new life hack now is if I'm
Oh,
hosting a
wow.
party, 60
Yeah.
60 must deliver at least the drinks because
Oh, wow.
it's so unnecessary to go and have to queue up and try and get refreshments yourself and
Yeah.
get the house ready to have guests. So double thumbs up for 60/60.
Awesome. Maybe you might subscribe to their Plus subscription, the 99, pay that extra 99 rand.
Maybe.
Yeah, my next stock pick is AVI, which is a consumer brand holding company for various food, beverage, and fashion brands. Financially, AVI is in a strong position. The business has relatively low debt and boasts a high coverage ratio. And yeah, this highlights its ability to comfortably service its debt obligations while continuing to reinvest in operational efficiencies. It's also known for stable dividends and recently declared both a special dividend as well as a 17% increase in its half-year dividend, which signals healthy cash flows and a commitment to returning value to shareholders. And the company's strong legacy brand positioning also allows it to pass some of those costs on to consumers. And yeah, as they consistently produce fast-moving consumer good brands such as Five Roses as well as Baker's Biscuits. And while there are some risks, particularly around the I&J fish brand, their performance has been a bit constrained due to low catch rates. I think these are still I think that the management team is managing it quite well, and it doesn't necessarily overshadow the group's overall strength. And yeah, AVI continues to demonstrate operational discipline and consistent profitability with very dependable dividend payouts. And then my final stock pick is Advtech. This is a leading private education group that I believe presents a great growth opportunity in the education space. And the company has maintained robust double-digit earnings growth driven by consistent enrollment increases, expansion projects, as well as solid cost controls. And it's been steadily reducing debt levels and has capacity to cover its interest on debt, which essentially signals sound financial health with the ability to fund some of its growth plans, which are quite robust over the next 10 years. And speaking of growth, it is launching the new high-impact campuses, such as the Rosebank International University College in Ghana, as well as a new combined Sandton-based campus, merging both the Varsity College, Vega, as well as its culinary school. And yeah, the institution is also pushing for university status in South Africa, and I believe that this move could potentially unlock even greater value once you're invested in it. So yeah, in addition to its recent acquisitions, as I said, 10-year expansion plan cater to the growing demand in education as well as distant learning in South Africa and other African territories like Ethiopia and Kenya. And yeah, overall, this portfolio of stocks are anchored in fundamentally strong, dividend-paying, and efficient companies with the aim to provide steady returns over the long term. And yeah, I think it's important. I think these are like solid ones to also add to your portfolio in addition to Bright's stock picks.
Good. Thanks, Boitumelo. Just a reminder to our YouTube audience that we are taking questions. So use the chat function inside YouTube if you're watching this live to send us any questions that you might have to our stock pickers this afternoon. Thanks again to me. Simon Brown, founder of Just One Lap. Can you just unpack that name, please, Simon? Just One Lap. It kind of took me by surprise.
So it's actually a domain I registered an age ago. The logic is quite simple. We get just one lap at life, so don't mess it up. I mean, that includes health, that includes, relationships, careers, but it also includes finances, which is where I have a small bit of knowledge. So that was the idea, to go for just one lap.
Good. Anything else you want to tell us about yourself, or you want to dive straight into your stock picks?
So we were talking before we hit the go live button about comrades. Yeah. I do not do comrades. When the zombies come, they can bite me first. I'm not a runner. I'm a swimmer instead. So I do mid-mile, I do dolphin miles, etc. I'll be in Durban for July and do a couple of dolphin miles. That's how I get my fun. Running is painful for me. I'm a swimmer.
Fantastic. Well, all the best with your dolphin. What is it? Dolphin run?
Dolphin mile. You swim 1 mile.
Fantastic. Good. Over to your stock picks.
Thanks, man. So my first pick is AngloGold Ashanti, and I'm going to put it into two parts. First is the story for gold, and then for AngloGold Ashanti itself. And the gold story, I think many of us really know it. We're seeing central bankers buying with a lot more aggression, particularly since the Russia invasion of Ukraine. Suddenly everyone realized, or banks realized, that maybe their dollars held at banks and the like weren't so safe. The US treasuries could kind of be quasi confiscated. We've actually seen a growing trend by central banks since about 2016 buying into gold. And of course, gold is really designed for a time of uncertainty. And the pandemic was that. And the second presidency of Trump is equally that. The next tariff, the 90 days, expires in 34 days. No one has a clue what's going to happen before then or after then. So I think there's still a good case for gold. Goldman Sachs said 4,500 by the end of the year. I interviewed Meryl Pick from Old Mutual recently. She concurred with that number. I don't know where gold's going. Currently 3,400. But if we pull it apart and put it back together, AngloGold Ashanti, their last set of numbers for December last year, all-in sustained cost about 1,650, revenue per ounce around $2,250 an ounce. So even if gold doesn't go higher, if it stays where it is, AngloGold Ashanti and other miners are absolutely printing money. The trick is, what do they do with that money? We can see dividends coming our way, and certainly AngloGold has said 50% free cash flow is dividend. We can see share buybacks, although gold miners typically don't do that. And we can see them rushing off and spending it. Harmony's doing $1 billion down in Australia, buying a copper mine. We've got similar issues with Pan African Resources heading off to Australia. We've even got AngloGold Ashanti picking up into Egypt, although that was a script deal. So I just think gold's a good place to be, and I think the gold miners are good, and my pick there is AngloGold Ashanti. My second pick is We Buy Cars, new to the market, spun out of Transaction Capital last year. The story behind We Buy Cars, at the moment, they're probably fairly valued, maybe a little bit touch on the more expensive side, but it's their growth prospects. They're doing around 16 to 17,000 cars per month at the moment. They're targeting 28,000 cars, which is what they want to get to. If we look at it in the broader picture, a used car market's probably about 100,000 a month. So they're looking at about a 25, 30% market share. And I think they can absolutely do it. Folks, if you remember having to go and buy a car and go down to Elos Street or Lower Smith Street in Durban or wherever it might be, it was never a particularly enjoyable experience. The whole process just wasn't fun. And they've fundamentally changed it. My wife bought a car from them back in February. It was from Cape Town. We didn't even see it. We sent someone, an expert, to go and test it and make sure it was roadworthy and all of those sort of things. And it was a smooth, seamless process. And I think we're going to see a lot more folks heading there rather than going to the more traditional mom and pop secondhand places. And they can then get that market share growth. There's a second part to it as well, which we're seeing a lot more secondhand vehicle sales in South Africa. It's now approaching around 2.2 secondhand vehicles per new vehicle sold. This has been rising over the last decade or so, and I think it's going to continue rising. Even with the influx of cheaper Chinese, Indian, Asian vehicles, cars are expensive. You don't get much for 300,000. You don't get much for 500,000. You've really got to go and up the numbers. And I think that's where we're going to start seeing a lot more in that secondhand space, giving a lot more drive to We Buy Cars as a business. And then the third one is Purple Group. They're probably best known for Easy Equities. They've now got about 1 million active accounts on Easy Equities. They introduced their Thrive, they called it a loyalty program towards the end of 2023. Essentially, it was a platform fee, 25 Rand a month. You can jump through some holes and avoid it, but it now has given them a strong base of cash every year coming through, which really enables them to then sort of not have to worry about getting to that break even, covering their office costs and the like. And we saw that with the last set of results out in April. They are profitable, and the PEs unwound quite markedly over the year as they reach that profit. They're two areas of growth. The one is just going to be continued growth within the Easy Equities client base and assets within that client base. Nothing like some volatility like we saw back in April to help drive that. And then more than that is just all-time highs. Local markets, LATAM markets, Asia, Europe markets all at highs, US markets just off the highs. That creates talk around the braai. And the Saturday evening, everyone's like, oh, do you see this? You see that? And that gets more customers, more activity for Purple Group. And then they've got all of their other little products. They've got the crypto basket. They've got their property business. They've got a whole bunch else loans against your portfolio, etc. Those are all at this point very, very small. And when I last chatted with Charles Savage, CEO, he was talking around, the average client has around 1.3, 1.4 products on their platform. There's a lot of space for that to potentially grow and get more products into their hands. They're looking at other markets, East Africa, Philippines. They've just got some go ahead from the regulators in the Philippines to start a sort of a small scale operation there. It's with a business called GCash. GCash has got tens of millions of clients on their book. They're going to start offering equity solutions there. We'll see how that goes. Those sort of offshore things don't always work perhaps as much as we had hoped they would, but I think their local base is good enough to really drive that business. I have to say, when I was thinking about my stock picks, it was around 10. It's now trading at around 50. There has certainly been a buyer in the market the last couple of weeks. They seem to have stepped aside. We might get a slightly cheaper price in the weeks ahead. But 3 stocks, AngloGold Ashanti, We Buy Cars, and Purple Group.
Thank you, Simon. I couldn't find my unmute button. And a special shout out to my friend Anderson, who actually sent me a WhatsApp to say he's watching on YouTube and he can't put questions in, and there was a technical issue. So apologies for that. Tsietsi Mokhatla has an interesting question about can you advise first-time investors on what steps one can take to enter the game of investing in these companies? Of course, this show isn't financial advice. It's more education, and we do always recommend that people do take professional financial advice. But in terms of opening a stockbroking account, we do have a list of stockbrokers on our website, jse.co.za. You can find a broker, and a broker can help you open an account. Some of the brokers focus more on larger institutional investors, and some of them focus on more retail investors. So that's a good start. And we've seen that the questions are coming in. But before we dive deeper into some of the questions, Lonwabo, over to you, good sir, and if you could tell us something interesting and dive into your three stocks. Thank you.
Hi, afternoon, and hi, afternoon to the listeners. I thought something interesting. I don't know, for some reason I remembered this. I have a high propensity to misplace things. So I've kind of placed my cell phone on the car and drove off, and I guess I never saw that one again. But another interesting one, I once had my cell phone fall out of my pocket in between like the airplane seat. Was attending client meetings, etc. I realized it late. I thought, well, that cell phone is gone. And lo and behold, I was flying back on the same plane, same seat, and actually the phone was still there. So that was sadly, my daughter unfortunately also has a high propensity to lose things, but I can't blame her.
Good.
So
I recommend Apple AirTags for those of us propensity to lose things people. I've got them everywhere: laptop bag, car keys, house keys, wallets. It saved my
I'll remember
marriage.
that. Yeah. Yeah, so I'll delve into the stock picks. I mean, I joked earlier that I have a high propensity for pain, but really the thinking is that in our psychology as people, we tend to run away from painful endeavors. It's natural. It's self-preservation, and I think you see this playing out in the stock market as well. And so what happens is when businesses face difficulties, the market typically runs for the hills, and I think these three companies that happened in increasing degree. So I'll start with Mondi. So Mondi is obviously packaging and paper business. Primarily based in Europe. The paper business is a famously cyclical one. In Mondi's case, they make mostly packaging paper. So this would be your cardboards and a lot of the paper that goes into like cement bags and pet food bags. Now that part of the business, what's happened at least in the cardboard boxing business, is this bit of overcapacity in Europe and prices are weak. I estimate about 40% of the industry is losing money as things stand. So kind of needs better pricing. Typically, actually, prices have tended to bounce from these levels. And you're starting to see signs of that. So, and then the other part of the business is the cement bag business. So Mondi's is a global leader in that with 30 to 40% market share. And that business is much more profitable and tends to be more stable. So the consequence of the low box paper prices is that Mondi is probably making about 50% less profits than typically makes. Now we think that margins will improve from this low base. Interestingly, Mondi's also spent about 1.2 billion euros and another 500 million euros on an acquisition. So let's call it about a third of their market cap, increasing capacity during this down period. And so we think as they come out of it, you'll get the double benefit of improving prices and then just a bigger business, coming out of it. So we're quite optimistic that there's a significant return to be made there. I guess my second, what's been, I guess, a higher degree of pain has been Absa for many years, I think. And Absa, trades just below book value. And its peers trade at about 1.5 times book value. Now, so, nearly a third of the rating. Now, why Absa got itself into this position, you'd have to go back 20 years when Barclays was bought a stake in Absa, and Barclays had a very conservative credit appetite. Now, the consequence of that is that Absa lost a significant amount of market share, and then abruptly, Barclays pulled out, which actually meant that Absa had to provide its own backbone on things they were relying on Barclays to provide for them. So they then had to spend a couple of years fixing this operationally. Now, when they came out of this, they now wanted to claw back the market share that they lost, to the other banks, and they were very aggressive in lending. Unfortunately, this was during COVID, and they picked up quite a lot of bad credit as a consequence. And coming out of that, they ended up with a higher credit loss ratio compared to peers. And then the share kind of derated, and that's why it finds itself on a less than book value, nearly 9% dividend yield. But we think there's new management coming in. You think they'll be able to rebuild the talent and depth that's been lost in the business. But importantly, in the short term, they'll get the benefit of lower interest rates, and you'll see credit losses will start coming off. Absa actually now banks make less money when interest rates come off, just on the basis that they make less net interest margin. Absa's actually hedged this, and so that they won't experience this to the same degree as peers. So we think that profits as a consequence will begin to outperform the peer group coming out of it. And then, I guess the last one in a much greater degree of pain is Sasol. And I mean, Sasol's, I think the story is well known. The share price peaked well over 600 rands. The share is at, I think, at around 80 rands today. So call it down some 80 odd percent over the period. And I'd say, I mean, there are a couple of things that Sasol faces, some cyclical and some structural. So we're betting that some of the cyclical factors will begin to improve for them. And I'd say the cyclical one would be that chemical prices, which are about half the business, are actually so low that they basically just above break even in this business unit. So there's overcapacity globally in some of the chemicals. You're seeing some action slowly starting to take place, closures, etc., that will drive prices higher. But importantly, Sasol is also cutting costs in this division. They used to run a federated model. They're now moving to a centralized model that will remove kind of a layer of costs and allow them to start showing improving profitability. And then, there are some, obviously we know about the Lake Charles investment that they made, which was a significant amount of their market cap, and that's left the business with an indebted balance sheet. So they had an investor day recently where they took steps to kind of reduce this risk. So number one, they've hedged the oil price for the next 2 years, half their production at around $60 a barrel. So that's been secured. Number two, they've reduced, initially they had said that once the company reaches $4 billion of debt, they'll start paying dividends. They've now made that $3 billion of debt. So again, that will reduce the balance sheet risk. And number three, they've substantially cut the capex plan that they initially had by some 20 odd billion rands. So then that'll actually allow the business to generate more cash. And so and improve from there.
Thanks, Lonwabo. Another way to inflict unnecessary pain is just to run the comrades. So you could have done that. Good. So thanks for your three stock picks. We do have lots of interesting questions from the YouTube chat. Here's one that is not directed at anyone, so I'll just read out as many of these as possible to let the panel think. Nathaniel Nika says, for someone who wants to invest in water companies, which stocks would you recommend? And then James Morris has a question for you, Dumi. He wants to get some reflections from you comparing Stadio versus Advotech, and maybe we can get some thoughts there. And then Ele Mashudu is asking which brokers actually focus on retail investors. So totally understand your question, because our website probably has about 40 to 50 stockbrokers there. The easiest way may be to just go with the broker that's aligned to the bank that you've got, because then it will be easier and quicker around FICA, etc. To go with the stockbroker that's linked to your banker. This is another general sort of question for the panel, so we'll see who wants to take this one. Lucango Victor asks, is there usually a drop in stock price when dividends are paid to shareholders? And maybe we can even unpack why that would be. And then Lucango also asks, is there volatility on the market when the earnings of some of these larger companies come out, like Naspers, Capitec, Standard Bank, etc.? Ella Mashudu also saying this has been a great discussion. Ella Mashudu, you can actually see some previous episodes on our YouTube channel. Now, it's always interesting watching stock picks that are from the past, because the stock pickers may not still be supporting those stocks at this stage. But it's I find that the conversations are really good to just even get into what these companies are about. I didn't know, for example, that cement bags were such a big issue for Mondi. Just a big surprise for me today. So we're all learning. Anderson Simon Anderson wants to know from you, Simon, do we have any additional insights on the Purple Group ramp up to monetize their clients better? He says on a trend basis, any interesting metrics that you may have tracked as a long time holder? I think that's our current round of questions. Any volunteers for the general questions around dividends, around water, and then your specific questions, Dumi and Simon? Who wants to go first? Go for it, Bright.
Sorry, I'm not sure if the Nathaniel Nika that's online is someone I used to be in high school with. That would be awesome. There isn't a lot of Nathaniel Nikas in South Africa. I've checked. There's about 7 of them on LinkedIn, the whole world. So there's a possibility. In terms of investing in, water companies, that's been a very strong theme globally. But if you look at the biggest sort of spring water company and water bottling company, etc., it's been Nestle, which obviously, if you follow the headlines, you'll see that they're preparing that business to be sold to either private equity or someone interested in their water business. But there are quite a lot of other big listed companies in the sector, one of them, or being one of the biggest, being American Waterworks. It's probably worth a look, but in the long term, what we found, especially with clients who have invested in water businesses, is that for some reason these companies don't attract that much liquidity, meaning they don't get a lot of attention, meaning they always trade below, the sort of cash valuation. And if people are not interested, if market participants are not interested in a theme, it's very hard to make money out of it. So we've sort of stayed clear of those companies. But I mean, we've been talking about water companies making a breakthrough since the early 2010s. If you take all the share charts of most listed water companies since 2010 to today, you've underperformed the S&P 500 in the past 3 years alone. So if you just, the S&P 500 has given you more returns in 3 years than these companies have given you returns in I don't know, close to 15 years. So I'd stay clear out of a theme like that. But I mean, it's your capital. You decide what you do with it in the long term.
Thank you for that warning. Anyone want to take the dividend question, or otherwise do me or Simon if you're ready on your specific stocks?
Yeah, okay. I mean, I can go quickly. It does tend to happen that you get a drop in the share price once the dividend's been paid, but it's only because preceding the announcement of the dividend, the market kind of prices it in and starts to increase the price, and so the payment of it then results in that. Yeah, so it's not a okay.
Yeah.
So
go for
just
it,
to add,
right?
Sam, I would be careful in buying companies that have paid a massive special dividend. We've had, the unbundling from First Rand, for example, of the property portfolio. We saw some guys buying a lot of that after they've paid a massive special dividend, thinking it's going to come back to where it used to be. But that's not how markets work. If it's a special dividend, it means the cash is out of the assets. The assets are now worth what the assets are worth after paying down the cash. It's not all of a sudden magically go back to that cash level. So you must be careful of dividend traps like that. If you're a new investor, if you already hold a company that pays a special dividend, it's fine. I mean, if it goes, down a lot by the special dividend amount. But if you're a new investor, you're seeing a company all of a sudden is down 49%, don't think they're going to be up 49% in the next year or 2 years or 5 years just because they paid a special dividend. That's not how it works.
Good. And then to add on to that question, I think the follow-on question was, do we tend to see a lot of volatility on the market when a whole host of large stocks pay their dividends? Is that something that any of you have picked up or not really?
Not so much around dividends, but we can see particularly around earnings, and then it's about expectations. And a company will come out with what looks like an excellent set of earnings on the surface, and the stock doesn't do anything, and then investors are like, "What's happened?" And that's because the market was expecting it. Inversely, an excellent set of results could actually see a stock fall and get some volatility, again, because the market was actually expecting still better. So the market really is around what those expectations are, and then we get the reality when the numbers actually arrive, and it's a response to what was expected versus what actually ultimately happened in the numbers.
Great. And while you're there, Simon, do you want to touch on Purple Group?
Yeah, so it is their challenge. And I have to say, when I spoke with Charles, and this was back in April with their results, I was surprised how few products each of their customers had. I really thought it would be more. And to be clear, I mean, they've all got obviously an equity account, and that makes perfect sense. I was surprised by how little they had otherwise. And certainly, I think that we are going to probably see a sort of an increased effort from the business internally to try and do that cross sell, and that's the oldest trick in the book. I mean, we get it all the time. You get a Checkers extra savings card, link your cell phone to it, and next thing they're telling you all about Checkers 6060. Although I don't know who doesn't know about Checkers 6060, but nonetheless. And I think there is going to be a stronger attempt by them to do it. Some of their products, I think, are quite niche, for example, but all of them to a degree. I mean, they've got their crypto bundle, that's doing fairly well, but I think most people probably aren't looking for crypto exposure. They've got their property where they're buying physical residential units around the country. They manage it. You get distributions, and then ultimately they will sell it and you'll take a profit. Again, maybe a little bit niche in that regard. Some of their insurer product, some of their script lending product, they just haven't found that sort of knockout one that really goes big for them. They will pick up that number. It will improve over time from its sort of 1.3 at the moment. But as I say, I mean, it's a number that I think should be closer to 2.5 or 3. So if they can really work on that, then absolutely we will see better revenue coming through and taking some of them, into a space of profit. And I think we'll also see them try some other things and then perhaps potentially close some down. I think some of them, they're going to try it and say, you know what, we tried, but we haven't got the level that we're particularly looking for. They, of course, also, Sanlam is a 30% shareholder in Easy Equities. I think we'll start to see a fair bit more in cross-sell there. They've also recently moved into actively managed ETFs. They took over the Cloud Atlas business, rebranded those. If they can generate the alpha, the returns, I think that could be a really good space for them as well.
Great. Simon, a question from a family member of mine. Nice to see you online, Itu. Asking about Anglo Gold Ashanti. Is your conviction tied more to gold's safe haven appeal in this volatile market, or are you seeing a discount to intrinsic value that's not fully appreciated by the market? We'll come back to you while you think about that question. And let's move to Dumi on the Advocate question.
Thank you. So I mainly focus my analysis on Advotech, and I think with Stadio, the PE is relatively high, and although they are seeing, growth, and they've also been getting some growth in their distance learning. It seems like distance learning is a growing thing within like the education sector. And I think that, right now, Advotech is for me, in my personal opinion, I personally prefer Advotech as opposed to Stadio. But there is a lot of room for growth for Stadio, and it seems like their share price has been also on an upward trajectory. However, the PEs do seem a bit on the expensive side.
You. Lonwabo Forever Young is surprised that chemicals takes up 50% of Sasol's business. So he's curious as to what else do they do, and how big is oil in their business. Simon, do you want to talk about Anglo Gold?
Sure. I think, intrinsic value in gold miners is really, really hard to do, simply because, I'm looking at for example, just a price to book of Anglo Gold Ashanti over the last 30 odd years. It's currently 3.4. The mean is 2.9. So it's a little bit above the sort of the mean for that period. Of course, the flip side is gold is at absolute record highs. And, through much of the aughts and into around 2011, they were trading at a fairly higher price to book than the current price to book. So certainly there is some logic there to potentially a decent in terms of intrinsic value. Price earnings again on these sort of stocks very hard to do, but interestingly the 20 plus 30-year mean is closer to 35. It's currently 15, and the forward is sub 10. We should expect to see that. For me, it is very much a case of where that gold price is and the cash that they're going to generate from it. And if there is further movement, if gold does go, and I said at the top, there are a couple of folks saying 4,500, and I I mean, there's no reason why not 4,500 in that sense.
Yeah.
That extra $1,000 just absolutely drops to the bottom line, and ultimately, hopefully, comes back to shareholders either in dividends. So I think the big money in AngloGold Ashanti is probably going to be more dividends than price movement. Price movement might come as well. We will certainly see some, but I think over the next couple of years, we should start to see some strong dividends, assuming they don't go and buy, go and buy Barrick or something crazy like that, which gold miners also sometimes do that sort of crazy stuff.
Good. So we do have just over 3.5 minutes to go, so we'll start to wrap up. So a couple of questions from Francis. I think Francis is trying to become a day trader. He wants to know if there's a mathematical formula to predict increase or decrease in a stock, like to know when to buy or sell. So I don't know who wants to take that question. And then Pizzo Moreme, something similar, more general, says, what does it mean when a company net income and adjusted core earnings are distanced? I'm not sure what that means. Maybe they are far from each other. So net income versus adjusted core earnings, if those are very different. But Lonwabo, just to put you more into the hot seat, there's a couple more questions on Sasol. James Morris remembers that a bank or an agency may have downgraded Sasol. What's your view on that? So I think, and then Pizzo Moreme is also concerned about the high debt ratio for Sasol. And so is it at the mercy of the market currently looking at that? So Lonwabo, maybe in 30 seconds, give us that, and maybe some brave soul will tell us how to know when a share is going up or about to go down. Go for it, Lonwabo.
Sure. Yeah. I mean, just quickly on what else Sasol does, I'd probably say the other key part of the business is they distribute gas in South Africa. So they pipe it in from Mars and then sell it to industrial customers. That business probably has a 3-4 year life as things stand. But it accounts for about 10% of group earnings. They'll be redirecting the gas internally going forward. And then, I mean, the debt issue is well known. They peaked, I think, at well over $5 billion of debt. And they're now down to about $4 billion. The way it gets measured by bankers is your net debt to EBITDA, which currently sits at around 1.7 times. If you get around 3 times, that's typically when they get worried. So we think that the bulk of the debt issue is behind them, and certainly with these steps they've taken now, the hedging and cutting capex and so on, they've reduced that risk further.
It's good. Well, we are out of time, unfortunately, but I invite the panelists to hop onto the YouTube chat and maybe answer some of the extra questions there. I still want to know what the mathematical formula for knowing when to sell a share or buy a share is. Then we can all go and retire and sip drinks on the beach, right? Bright, I know you've got an answer, but I'll have to leave it there. Maybe you can put it in the chat. But thank you, Bright Khumalo, Boitumelo Letsuma, Simon Brown, and Lonwabo Maqubela. Thank you. That's been a fantastic conversation. Thank you to the audience for tuning in. Please do tune in to our next one. Subscribe, hit that bell icon, fight in the comments so we can have engagement and the YouTube algorithm will love us. That was a joke. But thank you so much for your time today and have a good afternoon further.